Yes, students now. So the question is explain the exposure Fondir company faces with respect to falling sales revenue from Italy and explain and suggest how this exposure can be managed. This is the second question on the theory we are doing today. Means majority questions, they utilize the framework from whatever you have studied. But you have to present and discuss the things as per scenario, utilizing the information. You have to think whatever you have studied and apply, okay, on the facts given over here. Now, prepare a board report for the board of directors of Fondir company, which calculates amounts receivable from in dollars from Lothil in 4 months' time using the over-the-counter forward rate and OTC options. This part is on the currency risk. But what is unusual in this part is that is OTC option, over-the-counter option, which we have not studied, we practiced yet. This is the only question on OTC option. Calculate the interest return in dollars of cash flows from Lothil, where future contracts are used to hedge the interest rate fluctuations of 0.5%. Now, this is interest rate risk question. Calculate also the number of future contracts needed and the gain or loss in the future market. 9 marks. Okay, now consider the results be address the queries by board of directors with respect to alternative methods to hedge the receipt and margin requirements. Interesting, very interesting. So, what discuss if it would be beneficial founder to manage its financial risk or one part, and whether or not the company should communicate its risk management approach to whether or not. 9 marks, 2 requirements. Done. So the question is quite interesting. Now, the next point is, come here. We will be reading the scenario and identifying the information. Founder company based in USA dollar is involved in the production and sale of high quality food under its popular brand called Dilibili. Okay. Initially, its products were mainly aimed at the USA market, but increasingly the products are sold internationally to North and South America and to Europe. This rapid growth has meant that Fondir is expanding its production facilities and receiving its revenues in a variety of currencies. Okay, so Fondir has developed robust system to manage its operational risk. So far, it has not managed its financial risk from currency and interest rate fluctuation. Founder company's board of directors on the whole is supportive of the opinion that company's financial risk should be managed using derivatives products. And the company's approach to risk management should be communicated to its main stakeholders groups, including shareholders, managers, and lenders and employees. Foreign company's marketing director questioned whether these and other funds should be managed at all. He suggested the cost of managing such risk should outweigh the benefit derived from management of these risks, and there should be and therefore would be disadvantageous for the company. Now, so finance sector is saying that. So the first part you see here. Okay, this is the line. Finance sector argued that other risks, although many risks can be managed using derivatives, some risks were harder to manage. She gave the Italian market. Now the first part is coming. Italian market as an example where direct competitors from France and Germany have successfully penetrated the Italian market. As a result, the founder has found that its sales revenue from have been falling that it is due to the weakening of euro against dollar. The FD is of the opinion that the relative weakening of euro is likely to continue for some time and cannot be managed through that will continue and it cannot be managed. Now, students, this is the first part. So we will now, so let us proceed and try to write the answer of the part A. The part A, the requirement is it has two requirements. Explain the exposure, falling revenue, and suggest how this should be managed. The main, they are saying it is due to strengthening of dollar and weakening of euro. This is what they say. Okay, now so let us open it. So A part, Fondir company. So Fondir company, they say euro is weakening, dollar is strengthening. That is the main reason. Yes. So sales revenue, first of all, explain. The first thing is explain exposure. The first is explain the exposure. Sales revenue is falling from Italy. That is Italy, due to strengthening of dollar against euro currency of Italy. Now, so they're selling goods. Their products are sold internationally. So, students, the point is, since the company has squeezing revenues, the company has squeezing revenues, but cost is the same. in USD. The cost is the same in the USD. So if it does not increase price in euro, it may no longer remain profitable. It may no longer remain profitable in Italian market. But there are competitors from France and Germany. Yes, but there are competitors from France and Germany. From Germany. Who has euro and cost of production in euro, and their margin are not affected as those as they are being affected by for Fondir company. Now, it happens. This weakening is continue for some time. Short term, currency fluctuation can be managed by derivatives. But here, this weakening of euro is likely to continue, which means it will affect adversely the competitiveness of Fondir company in Italian market. It will affect adversely its competitiveness. Now, so it is economic risk for Fondir company. Explain the risk. Okay? Explain the risk. Now, how it can be managed. So, for long-term currency exposure, currency risk exposure, what is better? Tell me. What do you think? Swap. Derivatives are for less than 12 months. For the long term, swap. 1 year, 2 year, 3 year. Swap is better. Now, so for long term currency exposure, swap is better option, better than derivatives. Derivatives, as it can hedge currency exposure for much longer period than derivatives. It can hedge, but it must be worth considering. But it is that whether this exchange rate fluctuation and decrease in value of euro is going to be permanent. Swap cannot help in that case. In that case, yes. And Fondir company should evaluate how important is Italian market is for its sales. If it is of strategic importance, it should consider establishing a subsidiary in European market to have cheaper production cost in Euro. And then it can compete the rivals in market as well as reduce currency risk somehow. Done. Any confusion? Next. Second part. Prepare a report. Yes. Report to board of directors. Fondir company. Introduction. And then is comment on calculation and response to queries. And response to queries. Always do that. Make a format. Then, fourth point. Beneficial for, yes. Yes. Financial risk. Communication. Managing the financial risk. So the next is managing the financial risk and communication of risk management. Approach to stakeholders. Now, and then at the end, conclusion, because it is a report. So, in this way, it has to be done. So, I will be calculations here. Appendix 1. Amount receivable. OTC forward contract and OTC option. So first of all is Appendix 1, OTC forward contract. Come here. Fondir sells its products to the companies and customers based in Lothil, a country based in Europe. Whose currency is Lothil lira? It is expecting a receipt of LL 357 million in 4 months' time. Okay. No exchange rate derivative available for hedging Lothil lira. Access to OTC or derivatives. The first is 4-month FRA based on Lothil annual base rate of 6% plus basis points. And the USA annual rate of 3 point, okay, 3.3% less 30 basis point. The spot rate is this. What is it? Read the sentence twice. They say you need to calculate 4-month forward rate. FRA. Forward rate, forward contract. Currency risk it is. You need to calculate. First of all, you need to calculate forward rate. So, forward rate, we need to calculate. The current spot rate is using which interest rate? Okay. So, basically, 84 into 1 plus 6.6% plus 0.6%. It is Lothil lira per dollar. So the first exchange, so basically Lothil lira per dollar. So Lothil's current, the rate will come the above, it will be multiplied. And in the denominator, that will be 1 plus USD because dollar is in denominator. 3.3% plus 0.3%. This is how FRA is based on it, they said. They said it is based on it. So we have to think, we have to listen to them. So this is the exchange rate calculated. This is the annual rate. Okay. This is the annual rate. One more thing. Divided by into. We have to do one more thing. Yes. Into 4 by 12. Into 4 by 12. Because we need to calculate 4-month rate, not the 1-year rate. 4-month Marward rate is based on annual base rate. This is the second point. We have done it proportionate. Four by 12 and 4 by 12. Yes. Here you go. 84.8. 84.8. So this is the forward rate at which, so currency exposure, that is 357 million Lothal lira. 357 Lothal lira. So forward contract, receipt in dollar. This is Lothal lira per dollar. Now, this divided by this. It is in million. So if we do this, 1, 2, 3, 1, 2, 3. Now it's good. You are right. You found the right point. It is less. Thank you. Thank you. Thank you. It is less. Now it's good. So this is the receipt in USD under FRA. So now OTC option. The second is an OTC dollar call or put option. Dollar call or put option. They have to buy dollar. So dollar call. Okay, because dollar call or put. They have to buy dollars at an exercise price of 84. This is exercise price. So purchase dollar call options to hedge against, as to hedge the risk of decrease in dollar income. Now, so excess price. $84 Lothil lira. Excise price. So it means the whole amount will be converted at this rate. So income through exercising the option, this will be converted at this rate. Okay. At this rate in dollars. Exposure is the same. The next is premium, option premium. Now, this point is technical. The option premium is payable at the commencement of option. And they would borrow the money needed for premium using its overdraft facility. The company pay interest on its overdraft at 5.4%. 5.4%. What is the duration of option? 4 months. So for 4 months, they need to borrow money. Okay, just to avoid complexity, listen. First of all, let us calculate premium. Option premium. So option premium is, they say, 4 Lothil lira per dollar. Call option. Because we have decided call. So 4 Lothil lira into this dollar, 4 Lothil lira. So this is the cost in Lothil lira, premium cost. So cost in dollars, because it has to be paid in dollar in advance. At today's spot rate, and today's spot rate is, what is the rate? $84. The spot rate. The spot rate is 84. Divided by 84. It is in dollars. As today's spot rate is also 84 Lothil lira per dollar. This is amount premium. So premium cost plus interest cost. They need to borrow this money to pay premium for 4 months. Okay. This into 1 plus. This is they need to borrow at 5.4% overdraft rate annual. into 4 by 12. Into 4 by 12. So this is premium cost in dollars. Any point you want me to re-explain, I'll be happy. Up till now. Any point. Tell me. Final. Net receipt. Income less this cost in dollars. Okay. OTC option and OTC forward contract. Once again, quick review of options. The option is that this is exercise price call option. Why call option? Because they dollar call option. They have to buy dollars. Okay. They're receiving lot in lira, which they have to sell and buy it. Basically, call options are denominated dollar. They have to buy. So conversion at exercise price. Then option premium, which is 4 Lothal lira per dollar. So premium will be charged like that. Now premium has to be converted into dollar at initial 2-day advance. And today's rate is also 84. Now this amount has to be paid through an interest. Interest will be charged. Loan, through loan, on which interest will be charged. Here you go. And here we are. I hope it is. Is that clear to everyone? Tell me. Any confusion? Next. The next part, Appendix 2. Appendix 2. Appendix 2 is about interest rate risk. Short-term investment. So Fondir will choose the more beneficial financially hedging instrument to hedge the cash receipt from Lothal. Once the cash has been received in 4 months' time, the previous case, very good question. On 1st May, and exchange dollar, it will be invested for further 5 years. 5 months, sorry. It will be invested for further 5 months. Okay. Now, it will be invested for 5 months before the cash is read somewhere else. Founder company's board of directors wants to know how interest rate futures can be used to hedge against an increase or decrease in the base rate. Fondir can invest funds on a short-term basis at USA base rate, which is currently 3.3% less basis 30 basis point. Now, the following information is provided for June futures. The 3-month future contract has a size of this. The June future contract is this price. In the calculation of the following settlement of future is at the end of the month. Base is diminished to 0 based on monthly. No basis risk. Margin ignored. The board has heard that dealing with future can be expensive because of margin requirement. They want to know what margins are and whether or not dealing with future is expensive because of it. Okay. First of all, we need to solve for futures. Two possibilities are there. Let us proceed. Now, the problem is, what is the problem? The students, based on information, we get lost in the question. We miss the track. Please keep yourself on track. If you know how to solve a question for futures, first of all, they say receipt from previous. Which one is higher? So receipt through, in the previous part, it is higher through forward. Okay. So the receipts in LL are higher in terms of dollar if hedged through forward contract and are how much? This. Why it is not linking it? Okay, so I will simply type it here. So 4,200,098 dollars. That will be used. Now, today's spot currently 3.3%. Base rate today 3.3%. 100 minus 3.3. Okay. Next, futures. June futures price. They have themselves given us 96.1. Now, basis. Spot minus future. Unexpired basis. Now, how to calculate? On 1st May, they will receive invested for 5 months. But that is irrelevant for futures. 1st May. And what is the date today? What is the date today? It will be, I think, in the previous exhibit. Yes. Previous exhibit tells the what is the date today. In 4 months' time on 1st May. In 4 months' time means it is 1st January today. Okay. It is 1st January today. It means. Okay, here it is again. It is also given here. So 4 months' time. So before and 30th June. So today. How much total time? Tell me. These are 4 months. And these are 2 months, 6 months. Remaining is 2. This is 2. So 2 by 6. 0.20. One thing, we need to calculate number of contracts. Number of contracts. So amount, yes. Contract size is 500,000 divided by 500,000. And they will be invested for 5 months. 5 divided by 3. 14 contracts. 14 contracts. Okay, now. So let us proceed. Then they say 2 possibilities are there. Interest rate can increase or decrease by 0.5%. So 2 possibilities are there. The first, interest rate increase by 0.5%. The other, interest rate decrease by 0.5%. Two possibilities are there. So then 2, how much it will become? Increase by this 3.3 plus 0.5%. Here you go. And here decrease by this 3.3% minus 0.5%. Yes. Here you go. Now, two cases are there, one by one. Future market. We have to calculate closing future. If you have forgotten the formula, spot, right? Basis is equal to spot minus future. Future is equal to spot minus basis. Spot, no, we need to calculate spot. This is 100 minus 3.8. Spot minus unexpired basis. So closing future here, spot minus unexpired basis. Now, one by one, we will solve. So future market. Yes. So here it is. They have to pay interest or receive interest by future initially. So by, since they have to receive interest by futures initially. Do mention that. Future market. So initially buy at this rate. Sell at this rate. Loss on future. This is loss. Yes. So total loss. That is equal to 0.1% into 3 by 12 into number of contracts. 14 into contract size. You can solve it through ticks as well. Choice is yours. This is the total loss. On futures. Now, actual market. Interest income. Interest income. Total amount is here. It will be for 5 by 12, 5 months. And they can invest for base rate less 30 basis point. So what is the base rate here? 3.8%. Less 30 basis point. This is the interest income. This is the interest income. Less loss on futures. Loss, income will be, it will deduct from income. Net income. $59501. Net receipt. Come to the other side. So future market. Original position is the same. That is buy futures. Loss calculation sure. This one. Is that okay? Right. Buy future at the same. sell at this. So gain, total gain on futures. So let me calculate it. It is 90 ticks. 2 tick. Same way it can be calculated, but for you, I'm doing it other way. So value per tick has to be calculated. $500,000 into 0.01% into 3/12 value per tick. So total gain on futures 90 ticks into 12.5 value per tick into number of contracts. Gain, right? Now, actual market, interest income. This is the amount into 2.8% minus 0.3%. 3 basis point less than that into 5/12 into 5/12. And then gain on futures. This net income. Net income. So we have done the calculations as requested by them. The requirement is interest return in terms of dollars. They didn't ask the ultimate effective rate. So we are not calculating that. Okay. Now, so comment on the results. So come here. Let us start commenting. So, students, introduction, first of all. In this report, it is shown that how income from Lothil, can be hedged for currency risk and later on investment interest rate risk on investment of the same can be hedged using current interest rate futures. And comments have also been given on the same.
Found.
On the same. And furthermore, management of financial risk and communication of risk management to stakeholder have been discussed. Done. Now, the first of all, two things are there. Results obtained in Appendix 1 and 2. Now, so first of all, forward contract and option contract, OTC option. So, as per the Appendix 1, the receipts of company, if are hedged through forward contract, are more than OTC options. And there is significant difference of, you can calculate how much it is. 4200098 minus 4043976. Dollars. So 1.5 difference of this is there. And this is, you see here, premium is much higher. And this is clearly because of high premium to be paid on options, which is much higher than this difference. and stands at 202 or 206024 and stands at this amount. Now, so forward contract is a better option, better, not option, better hedging technique. Don't use such words which actually create confusion. Okay, it's better hedging technique to hedge this risk. However, if exchange rate move in adverse direction, does not move in adverse direction, option gives right to lapse it and benefit from favorable movement which forward contract doesn't have. Now, interest rate income. Now, Appendix 2. And you see in both cases, the result is the same. 5901. Now, as per Appendix 2, as per Appendix 2, the futures ensure that interest income is fixed at $59501 in any case, whether in the market interest rate increases or decreases. It fixes that. Now, but it is based on assumption. What are the assumptions? That there is no basis risk or margin requirements, which are not true in actual market. Yes. So, which are not true. So, the interest income may not be received of same amount due to basis risk. We have commented on the results. Address the queries by alternative hedge. Yes. No, this is beneficial. Okay, with the alternate and the margin requirement. Okay, right. And it is 9 marks. It means we have to discuss in detail. It is not enough. Margin requirement, alternative method. It means we need to discuss margin requirement in detail. All marks will tell how much to write. So alternative method. So Fondir company should consider to use alternative method without derivatives. Okay? Methods. Should consider to use, yes, method. The receipt from Lothil company. For example, other than derivatives, other than, because they don't want derivatives, other than derivatives. For example, they can offer the customers in Lothil a discount for immediate payment. Immediate payment, that is called payment in lead. That is called a lead payment. Or they can hedge the receipt using money market hedge. Money market hedge. By short-term borrowing and investing to manage this risk. Now, so these both ways can be used for hedging. Done. Hedging currency risk of receipt. Now, margin requirement, we have to discuss. Margin requirement. This the first part. We have discussed alternative method. You can give this heading as well, alternative methods. You can give this heading here and margin requirement. Yes. Students, as futures are traded in stock exchange, so all the parties wanting to buy or sell futures must have to deposit margins. This reduces or diminishes. This reduces the default risk of either party on the contract. So, Fondir company has to do the same, to deposit an initial margin per contract to the account, to its account in exchange, stock exchange. It has to do that. If a gain arises on its future derivative, it will be credited to its account. And if loss occurs, it will be deducted from its margin account. This is called marking to market. And by doing so, by entering into this contract, and by entering into this contract, any shortfalls in the margin account are called on a regular basis by the stockbroker. Yes. Thus, a small amount of margin is used to enter into contract of large amount. Yes, done. It is mandatory. We have discussed it. Now, the next requirement is it will be beneficial to manage financial risk? The first exhibit. They have robust operational risk. They have not done these risks. And then communication to key stakeholders. And they are of 9 marks once again. Okay. Marketing data, the cost is too high. Benefits are outweigh. Now, so this is the whole story. So management of financial risk. First of all, so 4 marks, around 4.5 marks. Board of director is saying something, marketing director is saying something. Now, so what is risk management? Risk management means to make cash flows certain for the business and reduce variability. Now, listen, whatever I am discussing in this part, you see here, this question is typically reflecting your exam pattern, that what type of question you have on the theory. This discussion is purely the first part related to calculations, comment on the results. The second part is alternative method of hedging and margin requirements, knowledge based from the bookish knowledge. You have to link here a bit. The third, you might be thinking, I have not read it anywhere. Again, this was, so three types of, again, this is some knowledge and majority is about scenario. So 3 types of questions you can face in the AFM exam about theory. One, where majority knowledge will be used, some linkage with the scenario. Just like that, a margin requirement. Majority knowledge you have about margin, then you link it about the scenario. The second is where it's pure scenario and a framework of AFM knowledge. The third is which is related to calculations, interpretation. So these 3 types of questions are there. Okay, normally in more than 90% cases. So you should be ready for that in exam. So come here. So what is risk management? Variability. Reduce variability of cash flows. To financial risk management. Yes. Variability of cash flows. Considering the marketing director's comments considering marketing director's comments. What marketing director is saying? That cost of managing risk outweighs the benefits of these risks. So he might be right to some extent that this is important factor to be considered while managing risk. This is important factor to be considered. But there are some benefits of financial risk management which cannot be ignored. Cannot be ignored. Such as when cash flows are become more predictable by managing it. It helps in better planning and decision making. Better planning and decision making. And ultimately, operations become smooth. Moreover, the cost of capital is reduced. As risk is reduced, so founder company should evaluate. Now linking to scenario. The impact of risk management activity on its overall management of business and cost of capital. As a reduction in cost of capital means increase in the value of company. Increase in the value of company. It happens. So marketing director has been unable to consider indirect benefits such as reduction in financial distress, satisfaction of stakeholders about management of risk. So these benefits should also be. What is financial distress? I have discussed above. You might be thinking this is some new word. No, it is not new. You know, financial distress is that when a company is uncertain condition, that how much cash flow will come, too much risk, you cannot make big decisions. You cannot make decisions with confidence. Everyone will be in panic in the company to some extent. This is financial distress cost. So these benefits should also be considered while assessing cost and benefit of risk management. Yes. Done. The next is communication of risk management approach to stakeholder. How it is beneficial. Stakeholders. Now, before moving to solve it, what comes to your mind when you think stakeholders? The first stakeholder is employees, management. When they get to know the risks are how the risks are being managed, they got to know about the approach. What will happen to them? They will be have confident about the future of the company. They will continue to work, and their productivity will increase, satisfaction will increase. Lenders, if they get the knowledge of risk management, how it is going on about the founder company, they know that risks are properly being managed. They may be able to lend more money to you because now they are about certain about the cash flows and the future of the company. So you have to communicate to them. Shareholders, will also be happy. That's how risks are being managed. So it will help them in making an investment balanced portfolio, diversified portfolio of investment. It will help them for their investments. So it will increase the confidence between the stakeholders and the company. It will have impact, clear-cut impact in the market on the shares of the company. But some information which may be misinterpreted by the market, that should not be given. Giving too much information is also dangerous. Giving too much information is also dangerous. They need to create a balance between giving enough information and avoid giving unnecessary information. Now, students, conclusion. Afterwards, you will write. So conclusion. In this report, along with the appendices, it is clearly shown that how currency and interest rate risk can be managed for the founder company. And then results have been discussed of the hedging. The report also addresses the queries raised by the board. Regarding alternative method of hedging and margin. Then reports compiled by, report compiled by, like this, and date. Need not to mention any name. Enough. Only write this.